If you're a Californian considering relocating out here to Colorado, there's a tax story you've been told that's probably wrong. And the version you haven't heard is probably going to save you between $13,000 and $15,000 per year. I'm Nick Ahrens. I'm a local Broomfield real estate broker who specializes in the area between Broomfield, Bullard, and Denver. And I've walked dozens of California families through this exact tax math during their relocation. So here's the comparison I'm going to break down for you. A $900,000 home in California versus a $600,000 home right here in Broomfield. Same household income, we're going to approximate it at $200,000 per year. And by the end of this video, you'll know exactly what you'd save if you made the move. And I'm going to tell you the one trap that most Californians fall into when they're running this math on their own. Let's start with what property taxes in California actually cost you in 2026. Most Californians are going to say that they pay about 1% property tax. Now, that's partially true, but it's kind of misleading. A lot of that's because of Proposition 13 base rate. So, the real effective property tax in California for new California buyers right now is between 1.15% and 1.35%. That's once you factor in property taxes with local school bonds, wildfire mitigation fees, infrastructure measures, and other costs that get factored into property taxes. Now, according to Onwell's 2026 data, California's median effective property tax rate is actually 1.21%. New buyers get hit the hardest. Proposition 13 in California caps annual increases at 2% once you own the home. But the moment you buy it, the property tax gets reassessed at full market value. You lock in at today's high valuation of the property for the next 30 years. And if you buy in a Mello-Roos district, which is very common in Irvine, Rancho Mission Viejo, Chula Vista, parts of Riverside County, most of the newer Sacramento subdivisions, well, add another 0.15 to 0.5% on top of that already. So on $1 million home in Irvine, just the Mello-Roos alone can often add $5,500 a year to your bill. To put it in real dollars, Orange County's median property tax bill is about $6,400 per year. Palo Alto's median is over $23,000. California's statewide median is $5,134. That's double the national average. So when somebody tells you, hey, California's tax rate is low, they're actually looking at the wrong numbers. Now let's look at Colorado because the state uses a completely different system than California. Colorado uses a three-step system. Oftentimes it feels very confusing to first-time homebuyers, but once you see it, it makes a lot of sense and the advantages become obvious. Step 1, the state sets an assessment rate. For residential property in 2026, that rate is 6.7%. Step 2, the county assessor determines your actual market value. Step 3, local mill levy gets applied to that assessed value. So here's what that means in plain English. California taxes you on 100% of your home's market value. Colorado only taxes you on less than 7% of it. That single difference is the whole reason Colorado's property taxes are so much lower. Let me walk you through the maths and make a lot more sense of it real quick here. And let's use a typical $600,000 home right here in Broomfield as an example. $600,000 times the 6.7% assessment rate equals $4,200 in assessed value. That assessed value gets multiplied by Broomfield's typical mill levy of around 85 mills, or in other words, 0.85. That comes out to $3,417 a year in base property tax. Compare that to a $900,000 home in California at 1.27% rate, which is going to be just over $10,000, almost $11,000. That's around a $7,500 difference per year, every year in property taxes. But the property tax is only half the story. The bigger swing is going to come from income taxes state to state. California's top income tax rate is 13.3%. Now compare that to Colorado's flat income tax rate of 4.4%. So on a family earning $200,000 a year or more, That's a huge difference and a lot of money back into your pocket. In California, that $200,000 household pays roughly $16,200 in state income taxes. Here in Colorado, that same household pays about $8,800 in state income taxes. That's a $7,400 swing between the two states. And that's just from income taxes alone. Add that to the roughly $7,400 in the difference of property taxes, and we're looking at almost a $15,000 swing for your family, just between moving states. Same career, same income, same family, different state. Over 10 years, that's about $135,000 in savings back to that family's pocket. Over 30 years, that's over $400,000. And that's not counting the price of the home. The difference between $900,000 and $600,000. Now you can take that additional money and put it towards travel, investments, retirement accounts, equity, whatever you want to do. It saves you a lot of money in most situations to move out here from California out to Colorado. Now here's the trap that most Californians fall into when trying to run this math on their own. Not every Broomfield, Denver County, Boulder County home has the exact same tax profile. If you're buying one of the master planned newer communities like Anthem Highlands, or Baseline, you need to know about the Metro District taxes. These are local taxing districts that fund community amenities like pools, parks, schools, trails, and a lot more. Metro District taxes can often add $1,800 to $4,500 a year on top of your base property tax bill out here, depending on the specific district and when your home was built. Now, it's not a deal breaker. Metro districts fund amenities that make these communities what they are, but you need to budget for it correctly. Before making an offer on any home in Broomfield, always ask for the current year's tax bill and ask for the Metro District mill levy breakdown. Even with the highest Metro District taxes factored in, the California family moving out here to Broomfield still often saves over $10,000 a year compared to what they were paying out in California. The savings shrink from $15,000 down to about $10,000, but the move still financially makes sense. It is still financially a win for that family in this example. One more thing California sellers need to know, especially if you've owned your home for about 15 to 20 years or more. Prop 13 is very, very valuable when you own. If you bought about 20 years ago for $400,000, your home's likely worth about $1.8 million or so today. That means your taxes are roughly going to be around that $5,200 a year mark. A new buyer for your home is going to spend about $21,000 a year in property taxes, which means that your Prop 13 tax savings on your home are worth about $15,000. But when you sell, you give up that shield. And here's what most people miss. When you sell a primary residence you've lived in for at least 2 of the last 5 years, you can exclude up to $500,000 of capital gains from federal tax if you're married, or up to $250,000 if you're not married. So you cash out that appreciation tax-free, you move into a lower cost market and immediately start saving $15,000 a year on ongoing costs. For most 55 plus Californians with substantial equity, the math is still strong and often still favors moving. Hey, now there is one group this often doesn't apply to, and it's California homeowners with a Prop 13 tax basis of below $300,000 who plan to stay there 20 plus years and really don't care about the liquidity. They just want to stay in California. You love it, great, you should if that's the case. If that's not you, for everyone else, talk to your CPA, but to me, a lot of things indicate that the tax math is there in your favor for making that move out here. Now, if you want to run your own numbers, here's the most simple way you can try to figure that out. Obviously, talk to a CPA, they're going to know more about your specific situation, but here's an example. So on line 1, you're going to write your current California property tax bill. Line 2, you're going to write your target Colorado home price, and you're going to multiply that by 0.05. which is going to be a rough estimate if you don't know the mill levy yet. On line 3, you're going to have the difference between your California income tax rate and your total taxes there versus your taxes compared to Colorado's state income tax, which is flat 4.4%. And that's gonna get you a rough ballpark of your first year savings. Hey, so if you want me to run the numbers and just kind of ballpark these estimated figures for you and your specific situation, go back to my page. I've got my cell phone number there, I've got my email there, shoot me a message, and all I need is 3 bits of information. One is the zip code you're in California, 2 is your property tax bill, and 3 is that estimated price range of a home in Broomfield, Boulder, Denver, wherever that might be out here in Colorado. And give me about a day or 2, but I'll give you some ballpark figures. I'm not a CPA, so I can't do that level of detail, so don't take it as 100% guaranteed or anything like that. But I will be able to get you some rough ballpark numbers that are gonna be a lot more accurate than anything I've been sent or anything I've been able to find online for calculators like this kind of thing. Also, if you've made it this far, give me a like, give me a subscribe, and I look forward to hearing from you soon.